You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody, welcome back to Options Bootcamp. It's good to hear that music. It has been too long since we got back in the old Options Bootcamp drill instructor squad proving ground. Welcome back. Happy New Year to all of you out there. Let me kick things off by just apologizing for not getting more shows out to you guys. We know you guys love it. We was looking at the numbers for the end of the year, and you guys really like yourselves some boot camp. We kind of put the show on a bit of hiatus towards middle last year, or early last year. Actually, we did 2 new episodes in all of 2018, and you guys loved it. You spoke en masse, devouring over 250,000 hours of the show, and it was essentially dark throughout the entirety of the year. So if you guys really like it, you have spoken with your actions, and we have heard you. So we thought, what better way to kick off the new year than by getting the gang back together here to do a little bit of the old Options Boot Camp just for you guys. And joining me to help me do just that, it wouldn't be the same if it was just me on here. Oh no, I need the black-hatted one, my Options Boot Camp fellow co-drill instructor. Hopefully he dug his hat and his whistle out of storage, out of the closet there, out of the attic, because I'm joined by Mr. Dan Passarelli, the founder, the major domo over there at Market Taker Mentoring. Mr. P, welcome back to the old boot camp parade ground, sir. Do you remember how all this works?
Yeah, we just talk about stuff, right?
I think that's pretty much how it works. Yeah. Let's see if we can remember how things work with a little bit of a kickoff here by looking back at 2018.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Pull in, prepare to learn.
I always feel so festive doing this show. Even in January, it feels like you're in July, 4th of July. That's a reason to do the show in and of itself. We're going to mix things up a little bit. We're not going to do just your straight up basic training segment or something like that, options drills off the top of the show. We're going to start off, actually, because it's our first show in quite a while, and also the first show at the beginning of the new year here. We thought we started off kind of looking back at the year that was 2018 from an options perspective. And oh, what a year it was, Dan. A lot of things happened. I think 2018, you could sum it up a lot of the different ways. A lot of people sum it up as the year volatility returned, which certainly is, I think, an accurate way. A lot of people also thinking 2018 was the year a lot of people expected in 2017 when this new administration first took office. They assumed this was going to be a high volatility administration, yet we got kind of exactly the opposite in 2017, maybe luring people into a bit of a false sense of security there. So maybe you could say we got what we expected, what people were looking for in 2017, but in a year later, in 2018. So a lot of different ways to sum up the year. Dan, obviously you're interacting with a lot of different clients and people over there at Market Taker. How would you summarize 2018, the year in options, sir?
Kind of exciting, right? Lots of opportunity is really, I guess, probably the best way to sum it up, I'd say, right?
There was a lot of opportunity.
Yeah, I mean, you have volatility like this. I mean, you just have great opportunity. It's a real traders market, for real traders who are pretty well versed in lots of different types of strategies and are nimble enough to be able to, see a change happening, like a long-term change leaning to volatility, like what happened about a year ago. That's what real traders have to do, and it's exciting because some of our students had their best year ever in 2018.
Would you say that the clients, the students in general, were they intimidated by the return of volatility so aggressively, or did they view it more as an opportunity? What were you hearing from them, talking to them anecdotally throughout the year?
A little of both. So I had my work cut out for me this year for sure. I had some people calling me in panic, like, oh man, what am I going to do? I'm getting creamed. I'm down 20 grand this month. And then I had some people, who I hadn't heard from, and they'd be in a class and I'd ask them, hey, how's it going? And they're like, man, this is great. And this have my best year ever. So, different styles of trading contribute to which way you go on that. Different experience levels with trading determine which way you go on that. And I would say probably the best and most exciting thing of it is I don't think there was anybody, to my recollection, that said, oh my God, I'm getting creamed, options are not for me, and dropped out. Like, I don't know if it's just sort of my tribe or if it's everybody. I kind of feel like it's probably everybody. Like, they sort of embraced the challenge, and looked at it as a way to move forward, move with the market, and not. And I don't think really anybody got scared out, which was really a little bit surprising, but more than that, really, really exciting.
Yeah, that is interesting. Usually I often joke about that level, what is that take your ball and go home level out there in volatility in VIX land? And we threatened it, broke through it a few times. People have different levels, obviously. Some will say 25, not very risk tolerant, very risk averse people. Others will say 35 or 40. It depends on obviously your level of risk tolerance. But we never really hit those levels. We flirted with them a few times. But still, there was enough. I think also there's also the sustained amount of volatility you endure. And this year we endured many days, right, of sustained volatility, sustained 1% plus moves in the S&P and other indices. So that alone can also scare people. If they just see protracted moves going on day after day after day after day, that alone could tell them, you know what, I don't know what's going on. I'm taking my ball and I'm going home. So that's surprising to me and maybe encouraging that we didn't see that in your clientele there, which is, again, a good thing. We don't want people to get scared away at the end of the day. But we did see people getting scared into trading some options this year. That's certainly the case. It was a record year, pretty much however you break it down from an options perspective last year. Our friends over there at OCC announcing, blowing the doors off any other previous record, doing 5.01 billion, 5.2 or so total contracts and about 5.1 billion options contracts, which is just a huge record. Dwarfs the last record, I think, was around 4.2 or so back in 2011. So just blowing the doors off of it also shows you how long it's been since the options industry has really set a large new record. The options industry, options volume, it kind of plateaued for a while around that 4 billion level. 4.1, 4.2 was kind of the norm every year. So to see the industry blow through it like that this year with 5.1 billion contracts, it was a good thing in general. If you're saying to yourself, man, where did that volume come from? Where were some of the busier days out there? Well, we got it for you. Again, courtesy of our buddies over there at Trade Alert. I'd like to compile a lot of great data. You guys can check it out for yourself. Go to What's Trading is probably the best way to see their data in a more bite-sized, retail-friendly format. What'sTrading.com is the place to go to see a lot of this data. Let's go backwards from the bottom to the top here. The busiest days of the year last year. Actually, Dan, I'll let you play along before we do this. If you had to guess right now, the busiest day of the year last year for options, what do you think it was?
That's a good one. I would lean towards the first day in February where we had the really pretty precipitous drop, or maybe not the first day, maybe like the second or third day of that business.
Yeah, that would have been my guess, too. Around February 5th was the big sell-off day, and the 6th was also active. I would have guessed one of those 2 days as well. And yet they are only number 2. Number 2 is February 5th. We'll go from the bottom to the top, and you could play along with everybody else, Dan. Number 10 is January 16th. So January is perceived by a lot of people to be this quiet, and then it kicked off in February. And it's certainly exacerbated in February. But January is actually a little bit more rock'em sock'em than I think people remember. January 16th, number 10, 29 million contracts. Number 9, December 20th, again showing how active the whole year was. almost 31 million contracts. October 26th, number 8, 31.5 million contracts. Number 7, December 21st with 31.6 million. Then we get into October 10th with about 33 million. Then February 9th, getting to the Feb strip there. February 9th, 34 million. February 6th, which is the day I thought would lead it, 34.7 million there. February 2nd, so leading into that, actually, remember that week, the Friday going into that weekend also was pretty active, clearly as demonstrated here, 35.4 million contracts. And then February 5th, the day that actually, kicked it all off there, 35.8 million. But that's actually only number 2. Number 1, Dan, was actually October 11th, the day the worm turned, with almost 37 million contracts, 36.9 million contracts. So that was the busiest day of the year when the bull market, shall we say, took a breather for a protracted period. So it probably won't surprise you to learn, listeners, that October is also the busiest month of last year, with over 500 million contracts, 555 billion contracts on the tape, followed by number 2, January. Again, going back to how January was more active than people remember. 467 million contracts. Number 3, February, only number 3. 465 million contracts, and we fall off a bit. March, number 4, 434. And November, 429, and so on and so forth. The bottom month of the year, July, again, speaking to that summer doldrum, is still pretty active. 367 million contracts. Dan, I bet you can probably guess, I won't make you guess, what the big volume leader for products was last year. But we'll go in order of bottom again. Number 10 is VXX, our old volatility friend, about 78 million contracts. Then Facebook, number 9, 83.5 million contracts. Number 8, Bank of America, about 95 million contracts. Number 7, EEM, with about 114 million. Also IWM, so the two M's coming in there, also with 114 million. Number 6. Number 5, Apple, only number 5, Dan, with 134 million contracts. Number 4, VIX, $1.65 there. Number 3, Qs, 245 million contracts. Number 2, SPX, 362 million contracts. Dan, that only leaves one obvious contender for the number 1 overall options product of the year. I'm guessing you can guess it by now, sir. I eliminated all the other big players, right?
Got to be spiders, right?
Got to be SPY, yep, with 817 million contracts. So roughly over 2x SPX. But again, remember, there's a big notional difference in those contracts. So notional value-wise, SPX is still the leader. But contract volume-wise, SPY taking the top crown. Also, obviously, the biggest ETF out there as well. I kind of just gave the answer away, but if you had to guess, I'm sure you probably know, Dan, what you think the number 1 equity option was of last year. What do you think it was?
Gotta be Apple, right?
It does indeed have to be the fruit company blowing the doors off everything else. 134 million contracts for Apple. Number 2 is Bank of America. A distant number 2 is about 95 million. Then we get Facebook, number 3 with 83. Number 4, AMD. Number 5, GE, 69 million contracts. Then it falls off a bit. We got Micron, Baba, Tesla, number 8, about 50 million contracts. Netflix, the same, about 48 million contracts. And then number 10, we got Amazon, about 45.5. So just give you some idea of the flavor of the year. A historic year for options. Probably the reason why a lot of you were going into our archives and downloading a lot of those shows to get a refresher on how a lot of this stuff works, because we were kind of in uncharted waters. And it's good to have an actually refresher on the old options biz and the options market when things are hitting the fan like that. Dan, before we get on it, I also want to make sure, we haven't done this in a long time, so I'll make sure we have a whole stockpile of questions. We've tried to divert them to other shows over the past year, obviously, or so, but we still got more coming in and others we want to talk about. So I want to get the listeners on here in a bit, too, to make up for them for their lost year. But before we do that, any final thoughts on 2018, the year in options looking back, sir?
No, well, yeah, I mean, I guess so. Kind of related to what we were talking about, but kind of taking it one step further. Because 2018 had such large volume. I mean, it had an increase in volume. I mean, that speaks volumes in and of itself for sort of the not just the commitment level to trading, but the accomplishment of traders. Like, traders now are so much smarter than they were 5 years ago, 10 years ago, 20 years ago when we got started. People aren't afraid of options. On the contrary, they embrace them because they recognize the value that it can have for them. Traders now look at options as a way to protect themselves, as a way to generate income. Like for example, one of our classes that we launched this year, the MTM Smart Income System, which is, on income generation, covered calls and cash secured puts mostly. It's been a fantastic year for that kind of stuff, which seems kind of counterintuitive. Like, some people would be surprised by that if you're not like working within that system. It's been such a great year because of the increase in the VIX and implied volatility across the board. So I don't know. I think the people listening to this show who do put in the effort to further themselves as traders, like, you've done that and you should be proud of yourself. I'm proud of you.
There you go. Dan's proud. He doesn't get proud very often. So Take it from me. He's never proud. So pat yourselves on the back there, listeners. And we're going to do that as well, giving you guys a chance to shine on this show with all of your pent-up options questions from 2018 into 2019.
Mail call. Time to look at questions submitted by our listeners.
So festive. Feels like 4th of July, Flag Day. Take your pick of festive, patriotic holidays, and this show feels like all of them. Let's get into your questions here on the old mail call. Let's kick things off, actually, before we dig deep into our basket of emails here, Dan. We got a fun one going on right now that I know, given the volume last year, everybody loves Apple. We got a fun question raging for our question of the week right now, which is kind of timely and interesting, I think, to our audience here as well, which is, of course, we did a poll a couple of weeks ago for our audience, and right when Apple first broke through 175 to the downside, we said, the 150 puts were around $2 at the time. The 200 calls were also around $2 at that time. We asked everybody, what do you want to do? Do you want to buy or sell the puts, or do you want to buy or sell the calls? Overwhelmingly, I think around 40%, it was people who said they wanted to sell those puts, harvest that premium, and then if they had to, get into the stock around 150. Well, lo and behold, this week, Apple broke through 150 to the downside, and those puts were now in the money. So we revisited that question this week, Dan. We asked you, those puts now a couple bucks in the money. What do you want to do next? Do you want to let those puts expire and maybe buy the stock around 148? Do you want to let those puts expire, get the stock, obviously, then turn around, sell the old covered call against it to wheel out? As they say, use the old wheel trade. If you don't know what that is, again, check our archives. We talked about that here on the show. Do you want to roll the puts down or maybe close the position out entirely? Dan, it's been hot and heavy. People are all over the place on this one. I'm curious, A, if you have a thought on this, because I know a lot of your mentees like Apple. And then B, maybe more importantly, what do you think our audience is voting for right now?
Oh, man, I will tell you what. I would say that a lot of people who are short puts are probably taking assignment on it and selectively writing covered calls on it.
Yeah, it's been fascinating to watch this one play out because everyone's got an opinion on Apple, apparently, and their opinions are. I don't think we've ever had a 4-question poll where the things are so unanimous for each one. It's been hovering around 25% for each since we posted this. Just started surging a little bit recently with the happily buying the stock. So like you said, Dan, taking delivery of the stock around 148 is now in the lead with around 28%. But that's a recent development. Then we have a tie for number 2. With rolling the puts down and closing out the position entirely with 26%, which actually to me is a little surprising. There's a lot more bearish sentiment for Apple out there than I maybe would have initially assumed. People want to close out the position, just take the loss and be done with it, or roll the puts down, expecting maybe some continued downside in Apple in the near future, but not a ton. They want to actually turn it around before they let those puts roll again, but also rolling them down, expecting this could get a little worse before it gets a little better. And wheeling out, only getting 20% now. So getting the stock put to you and then wheeling out the covered call afterwards at 20%. This is hot and heavy. If you haven't voted, get over there at Options. If you listen to this on the archives, it's probably done, but if you're listening to this in the next week or so, you can still get in there, make your voices heard. We also asked you guys at the end of last year, kind of nice wrap up. We do our crystal ball predictions on our Volatility Views show every week. At the end of the year, we do it for the entire next year. And we let you guys play along this year as well. We asked you guys, gave you 4 ranges of where do you think VIX itself will close at the end of 2019. We gave you, again, 4 ranges. So the low side, 8 to about 12. Then the more normal range of about 12 to about 17. Then the somewhat elevated range of about 17 to 23. And then the very elevated range north of 23. Mr. P, same question, sir. If you have a vote, have at it. Then B, what do you think our audience is voting for?
That's another tough one. I would say the audience is voting for A.
So low range, back to 2017, the 8 to 12 range?
Oh, no, I got them confused. No, I think people are looking for volatility to continue.
Okay, so very elevated, north of 23.
Yeah,
Oh,
yeah.
You got your Karnak hat on today, sir, because that is indeed the case. 37% choosing that, thinking we're going to have a little bit more Rock'em Sock'em Robots year ahead of us than the quiet, tranquil 2017. 32%, so hot on his heels, saying elevated, so north of 17. So put that together, north of 2/3 saying it's going to be over 17 next year. So a fairly volatile year, all things considered. About 29% saying 12 to 17. So again, a fairly decent breakdown here. Only 2% saying we're going to be back in the low range there, Dan. So not a lot of people lining up for the immediate return of 2017. All right, let's get to a bunch of questions. M. Gene has a question a lot of people had last year. Why no new shows? It's a long story. But we do a lot of shows here on the network, obviously. And we produce a lot of content, devote a lot of time to producing content for you guys. And then we also rely on sponsors from different firms to support that content. That way we don't have to charge you guys. You guys get all the content for free, which is great, right? You guys love that. It seems for whatever reason, and Dan, maybe you even counter this too, in the last couple of years, straight up options education doesn't seem to have become as sexy as it once was. When we first started, all anybody wanted to do was talk education, particularly for the retail audience, which is the core metric of this show. In recent years, though, it's become a lot more nuanced. People want a specialized show about volatility. They want to talk about the VIX or crypto or all these other special market segments like asset managers and advisors, which is extremely hot right now. Very few people or firms seem to be interested in educating the old retail again, which is kind of, again, the core mantra, the core mission of the option space is to grow that pie. And yet a lot of firms have abdicated that. Look at the broad network of education that's out there now. Look at the number of exchanges out there, 15. How many of them have an educational arm? Oh, yeah, I can tell you. 1. It's the SIBO with the Options Institute, kind of the legacy out there. And that's really it. You know, every other exchange used to have one. They've all gotten rid of them, or they've abdicated that responsibility over to our friends at OIC, who do a great job. They produce a lot of great content on our network. Joe and his team educating the retail. Eric and his team doing the advisors. But again, they're only a couple of guys. They can only do so much. They can't cover all of the education for the entire industry. So I guess that's a good thing for you, Dan. That's been a boom for you guys to fill that void and get a lot of business as a result. But for us, you know, in order not to have to charge you guys to produce a lot of shows, we ended up just putting the show on hiatus. But you guys love it. You guys kept downloading it. You kept consuming it. And so we're happy to bring it back, and then we'll worry about on the back end how we get somebody to pay us for it. We want to make sure you guys get the feed because you clearly enjoy it. I don't know, Dan, is this a boom time for you guys now that other traditional players aren't really in the educational game anymore?
Yeah, I mean, it's a gigantic boom time for us. And, you know, I kind of want to talk a little bit about the fact that a lot of the exchanges and, I mean, mostly the exchanges we're talking about are blowing off the educational arm. I look at that as the absolute biggest business mistake, biggest missed opportunity, not even missed opportunity, mistake that the exchanges are making right now. Because and I understand why they're doing it. You know, they're focusing their efforts on things like, you know, getting fungible products where, you know, like things like a whole bunch of things in the volatility complex, or like different ETFs that are similar to each other that arbitrageurs can trade, that end up creating more kind of false volume. I mean, it's good volume because it provides liquidity for the real traders that actually grow our business, which are retail and institutional traders. But it's false volume, and like the high frequency traders, do the exchanges make money on it? Yes, they absolutely make money on it, and that's why they're focused on that. But any business, any sport, any hobby, anything that's worth doing comes down to the fundamentals. If you want to really grow a pure, vibrant business that's not sort of based on fluff, like you grow the fundamentals, like you attract new actual entrants, people into the business. Like you've got to grow the ecosystem. And without and I think we've talked about this on the show before, without the little fish and the medium-sized fish, like right now we just got the big fish fighting each other, and sooner or later that doesn't work. So I don't know. I just believe that not focusing on education and not fundamentally growing the business is a big mistake.
No, I'm definitely with you on that. We've seen it on the exchange side. They've kind of abdicated that. And you can understand maybe to a degree why. They've all migrated over the past decade or so from essentially not-for-profit utilities into for-profit public companies with shareholders and analysts. And now you have to go to the shareholders and analysts and explain to them why you're spending this money on education. They just see it as an expense, a wasted expense. So bam, there it goes. It gets chopped off the books. No more expense. Analysts, shareholders are happy. But they don't. It's your job as the exchange to explain that that's a value-added proposition to them, and they haven't really done that. We've seen it, even not just the exchanges, even all the brokers have abdicated it. How many brokers have dedicated options education guys on staff anymore? Not as many as you would think or even hope anymore. So that's kind of the whole industry has kind of walked away from that a little bit, and it's a bit of a disappointment. So we're trying to reinvigorate. That's the point of the show. Reinvigorate good old school options education. There are still a few doing the good work out there. Brian Overby in his options playbook, which they do on this network. And of course, the playbook content, you guys can buy it on Amazon. Go to the website, optionsplaybook.com. There's great venues. Of course, there's Dan and his team at Market Taker mentoring over there. But there's a lot more that can be and indeed needs to be done. If you want to keep seeing record volume years like this, then we need to do more out there. There's a bunch of questions on Dan. Do you have a preference? Otherwise, I'll kind of just go in order. Anything leap off the page to you?
No. Go ahead down the list, man.
All right, let's go for it then. Let's see. Toby Sellers. He wants to know, what's our favorite paper trading platform? This is a good question. We get variations on this all the time. I think I'm kind of remiss. I need to do my round of due diligence again. I haven't gone and played. Usually I stay abreast, and we try to stay abreast of all the new platforms. We look at the main side. We don't look at the paper trading as much and what they offer there. So I need to kind of go and do a new round to refamiliarize myself on the point of entry for a lot of people to these brokers, which is the paper trading platform, what you can do, how robust it is. Is it full-featured, or is it kind of just some weird spin-off version? Can you really kick the tires and light the fires, as they say, or is it something else entirely? So I need to go do a bit of a refresher before I give Toby an answer. Dan, is there any particular platform that you guys like to use over there, or that you recommend to your mentees when they come to you and they want to kick the tires on options trading? Is there one go-to for you guys?
I mean, I think there's a few. Some of the ones that we recommend, of course, are the new E-Trade platform. They just changed the name to something kind of lame. I forget what the name is, but the E-Trade platform, which is the old Options House platform, / Trade Monster. That one's a good one. Thinkorswim, of course. I mean, that one's completely solid.
Yeah, that's kind of like the gold standard, right?
Absolutely. We'll use the old live file one, which is now with Lightspeed. I mean, it has its limitations, but it's got some things that it does extremely well. I trade on the Fidelity platform, the Active Trader Pro platform. Oh, and of course, TradeStation. Geez, how about that for being? I'm not trying to be political. I'm just, but I basically named every platform out there.
You got a good future in politics ahead of you. But you're right. The go-to for a lot of people is the TOS platform. They're really good, and you can't go wrong with recommending that. I kind of wanted I don't want to just be cliche and just recommend that one, but that is, of course, a good one you can go to. Some of the new entrants to the space, like, Robinhood, I don't think really offers paper trading, but we're getting some interesting inquiries about that one. I want to play around with that one. I haven't played around with all the Doe stuff either. So there's a lot of ones out there I want to play with that are new players out there that I can give you some more recommendations. But the old standards still work, and they're great. They're for a reason. All right. Laz, I like that handle. They want to know, what do we think about of call verticals here in USO? Maybe 3 month. 3 month, and then he says 5 or 10% out of the money. And he also wants to know, is it worth financing this with a put? USO, obviously, the ETF that attempts. I use attempts there because people have different flavors and views on the efficacy of USO doing this, but it attempts to track what WTI is doing out there. If you've been watching oil, oil's kind of been a bit of upswing. It's been downswing going into the end of last year. Now we're coming into the beginning of this year. It's on a bit of an upswing now. Just crossed the 50 handle, I believe, again to the north, to the upside, around 51 now in WTI. So maybe crude bulls getting a little bit of a lift there. I'm just looking here over the past week to see how well USO has tracked it. And it's moved about a point and a quarter or so. So it's tracked it decently over the near term here, which is kind of what you expect. Longer term is where some of the issues, I think, kick in with USO. So if you wanted to get in call verticals, I know this email came in a little while ago, so hopefully you got it in by now. Maybe you missed some of the pops, and maybe you want to dial it back. But when it was a little bit lower, I think for me, Dan, and maybe you have a similar view, maybe you don't. It's hard for me to divorce my outlook on verticals in USO with my outlook on USO itself, which is I'm not a huge fan of. So maybe we'll start there. Are you a fan of USO and using it for these types of, as a surrogate for WTI and things like that, getting some crude exposure? And then if you are, what do you think about 3 month, 5-10% verticals in USO?
I've got a position in USO. I do trade it. I like it a little bit as a substitute for WTI. The thing I don't like about it is probably ironically the thing that maybe some traders might like about it. I think it's too low priced. It's got the 10 handle right now, I think, right? And
yeah, just hit 11 today.
Oh, nice. Okay. So because it's nominally so low priced, like the options are so cheap, they're in the pennies, and it's hard to do anything with that. Like commissions make up too big of a percentage of the trade. And the bid-ask spreads are proportionately, like percentage-wise, wider, and so it's a little bit harder to trade, I think, because of its low-price nature. And low price does not mean cheap. It's just how the contract was engineered. So that being said, as far as verticals go, and I think when he's saying verticals, he's talking specifically buying call verticals, debit spreads, right?
That was my interpretation there.
Yeah. So with debit spreads or credit spreads, as far as a 3 month time horizon, that's too long a time horizon for that type of a trade. Maybe your outlook is 3 months, which is fine. Like, I'm not suggesting you change that. I'm not stating an opinion on my outlook or anything or what yours should be. But you got to remember, when you trade vertical spreads, debit or credit, time is an extremely big factor involved. Like if I buy like a 3 month call spread and tomorrow it goes up to my short strike, which is your objective with a debit spread like this, then guess what? I barely made any money. Like, I'm nowhere near what my maximum profit should be. And so over the next, 2 months and 30 days or whatever it is left until expiration, one of two things can happen. It can go back down and my profit is gone, or it can go up higher through the strike price. And granted, I make more money, but I'm just leaving money on the table because I picked the wrong spread. So, with debit spreads, you really have to kind of try and match your price target with your time target. And that's easier said than done. I mean, you're never going to get it right exactly. If you can do that repeatedly, call me. We'll work something out. Crystal ball scenario. But that's your objective. And so trying to predict where something's going to be exactly in 3 months is tough. So, maybe what might be better is maybe buy 2 or 3 or 4 week debit spread, let it get to your target, and then buy another 2 or 3 or 4 week debit spread, let it get to the target ideally, and do it that way. You'll make so much more. Your chances of being right are probably going to be higher. You won't have to worry about having a profit turn into a loss. You won't have to worry about leaving as much money on the table. I think you'll be more successful that way.
What about financing with a put, his other part of the question? Are you a fan of financing your verse, so kind of effectively legging into a bit of a bullish risk reversal here?
I don't know. I mean, I'm not completely morally opposed to it, but, I just feel like, why? What's the point? I'm going to take a positive delta position and add to it another positive delta position. And, as far as cash goes in your account, yeah, okay, you're financing it. The money that you put out is money you're taking in, but I mean, you're just increasing your margin being tied up, right? So in a way, you're really not financing it. You're adding more, you're taking away more money that you can use, you're tying up more margin. So even though cash wise, yeah, you can look at it and say, yeah, I'm financing it, but are you really? I don't know. I'm a big fan of being very intentful on trades. Like if you like a debit spread, you should trade a debit spread. If you like selling puts, maybe because you want to get assigned and take possession of it, or the other side of that, because I want to skate, then fine, sell puts. But doing both kind of feels sometimes a little non-committal and a little indecisive. But sometimes it makes sense too.
I like the idea of being morally opposed to a particular option strategy. I'm morally opposed to selling puts here. But you're right. People forget about the margin aspect of selling puts, right? They just think, I'm going to blast out puts, I'm going to finance it. And it does cover the outlay, but you're tying up more capital, right? So is that worth it to you? You got to do that math at the end of the day. But I see some people writing in with that question or similar veins of, should I finance this with a put? And they forget that there's capital being tied up there. So keep that in mind there, Laz. Let's keep rolling, see how many of you we can get on here in our first new episode back in quite some time. Shaking off the rust here. Feels good. Polishing my whistle here as we go. All right, we got a couple of thematically similar questions here from James and from Tim Tom too, looking ahead to 2019. James wants to know, what's your options wish list for 2019? And then Tim Tom wants to know, or Tim Tom 2, excuse me. What's the one thing you think options traders should keep in mind for the new year? All right. We'll tackle the first one. I think we kind of touched on the first one. Actually, I wouldn't mind seeing, if I had a wish list right now in the business, the industry, the market, call it what you will. I'll go back to what we were talking about before. I wouldn't mind seeing some of these exchanges and the firms in the industry in general just going back and kind of recommitting to their core mission of doing what we're doing right now, educating the broad retail public. And that education goes a long way. It's not just for your proverbial grandmother in Iowa. There's a lot of asset managers and advisors that we encounter out there all the time who need education. They may be financially sophisticated in other areas. When it comes to options, they're somewhat rudimentary. So they need a little bit of a helping hand. So this same basic education that we're doing for you guys could apply to your financial advisor with 200 million AUM or things like that. So this education goes a long way, and it needs to be done. And the fact that it's been kind of abdicated of late is, I think, somewhat alarming. And the one thing you think option traders should keep in mind for the new year, I would say this. We talked earlier about how 2018 was the year of the return of volatility. I think a lot of people have it on their mind because given what they've seen recently, relatively low volatility outside of last year, they think it's going to immediately go back down, right? Oh, VIX is going to go back down to 12. Maybe not in our poll, but in general, people think that. And I just caution you that we could be in new volatility regimes, new volatility regimes. We could see VIX vacillate around these levels for the better part of this year. If we see this government shutdown drag on, if the trade war drags on, if some other macro events continue to pop up throughout the year that manage to keep these levels elevated, we could see more sell-offs in the broad equity market. A lot of things could conspire to keep volatility elevated. So don't just immediately assume that's going to aggressively revert back down to 11 or 9, back down to that extremely low 9 handle again. That would be something to see. So yeah, keep that in mind. Volatility can go in regimes, and it could stay in that regime for quite some time. Doesn't mean it has to immediately revert. It is mean reverting over the long term. Over the short term, kind of anybody's guess. And right now, we're looking, at the volatility space, and the volatility futures are flat. The curve is flat. That means no one knows what the hell's going on. It's a coin flip out there. So don't just immediately assume reversion is on the horizon. The other shoe could be out there waiting to drop. Mr. Dan, same question here from James and kind of Tim Tom. If you have a wish for 2019, an options wish, and also if you have something you think people should keep in mind for the new year, sir, have at it.
Yeah, I'm going to really lamely just agree with your wish.
Super lame.
Yeah. I mean, my wish is that the industry and people not yet in the industry continue to see the benefit of options. And the way that happens is by nurturing the exchanges, nurturing the ecosystem, and focusing on education of retail and institutional traders. So that's my wish. As far as what to keep in mind, I guess similar concept to what you said, but basically, I'll look at it from a different perspective. Anything can happen. If you don't believe that, you've been living under a rock for 12 months. Man, I will tell you, we've talked a lot about this on past episodes. From 2008 to beginning of 2018. All these people who made money, got started in options in 2008 and made money by selling puts for 10 years, thought it was easy, and then it wasn't easy, and it's not a matter of being hard or easy. It's a matter of you making money or you not making money. And how do you do that? You get nimble, you kind of constantly look over your shoulder, constantly think, okay, what can change here? Really, really analyze your risk. And keep in mind black swan events, which I'm sure we've talked about at some point. Any crazy thing can happen. Any unexpected thing can happen, including a collapse in volatility, or a spike upon a spike. Anything can happen. And when you manage your risk, you select your positions with risk in mind. You manage your positions with risk in mind. It can it's a really, really powerful thing to do.
Now let's keep the power flowing here. We got a question from B-Boy number 2 here. What is the definition of a skew trade? This is an interesting one. The classical definition, Dan, I think the definition that you and I were kind of reared on back in the early formative days is that 50 delta risk reversal, right? It's a 25 delta put, 25 delta call, put them together, 50 deltas, and that's the kind of the classical definition, if you will, of a skew trade. If you're trading that risk reversal, you are trading skew. You're either selling puts and buying calls or buying puts and selling calls, vice versa, whatever you have up to on that skew trade, and that's as a result, you are trading skew. But the truth is, anything you're trading that's pretty wide as a vertical is effectively a skew trade. So it could be an at the money, far out of the money call vertical or put vertical, or maybe something that crosses the at the money. You're in the money on one leg and out of the money on the other leg. Anything that kind of spans a broad stretch of strikes is going to have a skew component that you have to factor in when you're trading. If you're trading a call vertical in a name, like let's say right before earnings, and you're not aware that people are bidding up that call skew like crazy, then you're not doing your homework, really. So skew trades come in many different flavors, many different varieties. The classical definition is the old risk reversal trade, but it can be any type of vertical, any type of spread in that single month type trade. Now, obviously, you can do diagonals and get into multi-month skews. We won't even get into that. We'll just keep it single month for now. But the classical definition is that skew trade, but the truth is any real vertical kind of counts as a skew trade. Mr. Dan, anything you want to add here for B-Boy 2 and his skew question?
Yeah, two things. One thing is that I would even lump in there, that's vertical skew, strike skew. I mean, I'd lump in there time skew as well, like term structure of term structure, different expirations. I think of that as a skew as well. And then to kind of expound on, maybe what the heart of the question could be interpreted as, what is a skew trade? Like, that's what a skew trade is. there are some people who are professional traders who that's all they do is they trade the skew. Like they'll look at that vertical skew that Mark was talking about, and they'll say, okay, well, the 25 delta put has a volatility of 40, and the 25 delta call, out of the money call, has a delta of 30. And that's what it is today, and they'll watch that relationship. And of course they'll hedge to be delta neutral because they only want to trade that volatility relationship. And so they'll watch that. And if at some point, the put volatility is 45 and the call volatility is 25, then holy cow, there's been a big shift. The put side got a lot more expensive. The call side got a lot cheaper. So maybe I'm going to reverse that. I'm going to buy calls and sell puts and then sell stock to get delta neutral and try and watch that skew revert. So it's pretty interesting. It's you can pretty much only trade that as a professional trader because you need the extremely low transaction cost and the extremely low margin that's available to professional traders. And you can't trade one or two lots. You got to put it on pretty big because you're trying to capture a couple of points of a Vega shift in that skew.
Interesting. Almost like we could do a whole episode on skew trades, sir. There's enough meat on that bone there to dissect. But you're right. I was trying to keep things simple, but you're right. You can go beyond the single month and get into, the term structure, which has its own skew. A lot of people view that as skew as well. So you could certainly unpack a lot there with that question. But for the base answer, go with the verticals. And if you want to go crazy, go the Passarelli route. All right, let's keep rolling here. Kraken, 1975. Excellent year. Good year. He wants to know, which of the Greeks do you utilize the most and why? I'll let you go first on this one, Dan. I'll be the charitable host. Is there a particular Greek you look for when you're out there slinging them options, sir, or are you kind of an equal opportunity? Then also, since you're kind of the guy who wrote the book on the Greeks, it's only fair to let you go first.
Well, thank you. You have the Greeks are interesting. You have to look at each of them individually, but they also work in concert too. So as far as like which one is the one I use most or my most favorite or the most useful, you got to know the three primary Greeks, delta, theta, and vega. It's nice to kind of throw gamma into that mix as well, but delta, theta, vega are the most important ones because what affects the value of your option, right? Direction, time, and volatility. That's pretty much it. I mean, interest and dividends play a small part, but they're largely predictable, not entirely, and the impact they have is a lot smaller than delta, theta, or vega. So watch those three. Delta probably has the biggest potential impact, because the stock can move unpredictably and violently potentially, which can be really, really great or really, really bad. So definitely look at delta. That's going to have the biggest risk and profit potential for you. Theta is a lot more predictable, but it can become a really powerful asset when you are familiar with all the nuances and use them appropriately. And then Vega's sort of the one that flies under the radar for people. Don't let that happen. That's a really, really useful Greek. You can use that to get edge on your option trades. And even if you're not looking at it offensively, look at it defensively. Don't let implied volatility hurt you. Make it help you. And the only way to do that is by looking at your Vega on each and every one of your trades.
Yeah, it's kind of hard to view the Greeks in any sort of vacuum, really, because you're right. They all do interplay and interrelate with each other. Like my short answer to this question is probably most of my trades revolve around Vega and Theta. But if you say that and Theta and Gamma are two sides of the same coin. So if you're playing with Theta, you got to be conscious of your Gamma. So there's a lot of different ways to unpack this. I'd say my own personal trading, primarily the one Greek I don't do as much directional type trading as maybe some do. So I don't rely on Delta as much, but that's not saying you can't pay attention to it, particularly maybe in an environment like this. Maybe so this is the one use case where delta would come into play, which is maybe you want to do a nice longer term stock replacement type strategy. Well, then delta there is very important because that's going to help you choose your option. You want probably something in the maybe 65 to 75 delta range. So that's where delta does become important. But again, it kind of varies on your strategy and what you're using. But in general, I'd say the latter ones are the ones I focus on. But again, gamma becomes a part of theta, so you can't really ignore it. And delta, you can never ignore either because it does come into play when things are whipsawing like we are right now. So you can't really ignore any of them. I know it's a cheesy answer. I hate to give that. But in general, I think for a lot of retail, it's kind of the other way. I think a lot of retail fixates almost myopically on delta, and they kind of ignore everything else. And they just want to do directional bets with options. That's kind of how a lot of them come in, and then they realize that's a hard road, and it becomes challenging for them. So I think they eventually graduate into learning about things like theta and vega, but they start with delta. Pro is probably the other way around, but still, I guess another conversation we can have. We have had on the show. Check out our Greeks, many episodes on the Greeks to learn just that. Okay, we got time for a couple more here. Let's see. Giorgio wants to know, do you think there's a natural cap on the number of options exchanges? I do. We're kind of around 15, I believe, right now out there, which is a ridiculous number. I'm doing a presentation next week, and I had to look back at from 2007 till today and how the option space has evolved. And just looking at the number of exchanges, there were 6 back then. That seems so quaint now. Now there are 15, more than doubled in that decade and change. And what does that mean? Does that mean all of these venues are slinging 30% of the options market and that it's hugely profitable for all of them? No, of course not. So it means there's other things going on there, which is the reason they're listing all these exchanges. And the primary reason, quite frankly, is that it doesn't cost a lot to spin up a new exchange. So if you already have a lot of these venues, like NASDAQ has 6 options exchanges. Are they all trading up, lighting up the world? No, of course not. But they have 6 licenses, effectively, 6 medallions with the SEC. And so they don't want to let that go to waste. So it costs them very little to spin up a new exchange just to keep that license active. And maybe they get a little bit of business on it. It's essentially the same matching engine, the same algorithm. They probably just tweak the fee model. So this one is maker-taker over here. This one's taker-maker over here, or some variation therein. And now all of a sudden they have 2 quote-unquote exchanges when they're the same thing, just with a little bit different fee structure and maybe a little bit different latency going on for some of them as well. We have 15 exchanges, but in reality we have a handful of exchange groups, right? We have SIBO, who owns SIBO and BATS. We have NASDAQ, who owns 6. We have NYSE, who owns ARCA, and indeed Amex. We have, of course, MIAX, which is doing interesting things in box out there. Those are kind of the main groups out there for exchanges. So I think we have to hit that level. They're already seeing it now. Every new entrance, every new quote-unquote exchange that gets spun up is effectively de minimis. They're doing certainly less than 5%, sometimes less than 1% of new volume. So it's not like they're adding a lot to the mix. I think we're hovering around that range where we're going to start realizing everyone's got multiple venues now, which they need. Another reason is the SEC says you can't charge 2 different prices for the same option on the same exchange. So they have to have 2 different exchanges they want to charge or give a rebate for one and charge a fee on the other. So kind of weird regulatory nonsense that drives a lot of this, unfortunately. But I think we're exploring that. There's a couple of more exchanges that are on the horizon now, but I think we're reaching that level now. Everyone kind of has them now, and the new ones are just de minimis at this point. I don't know, Dan, do you feel we're going to hit some natural cap to exchanges, or is it just on to infinity for us?
Yeah, I mean, I've got strong opinions on this, but I think that there is not necessarily a natural cap. I think we've crossed the level of absurdity for adding more exchanges, so it can't really get more absurd than it already is. So, if there was a cap, it would have been like 5 exchanges ago, and we blew right through that. So, I don't think there's a natural cap. We could just keep having more. There's no reason to, but we could.
I like that diehard cynicism in there, sir. Well done. Let's see. You want to do one more, or should we call it for this one, sir? I'll leave it up to you.
Oh, let's do one more. Why not?
It's been a year, right? We can squeeze in one more for the folks out there. Okay, let's go with this one. This guy wrote in a while ago. He's been waiting for an answer patiently. Might as well give it to him. This is from the Giddy Franciscan. He has a good handle, too, so he benefits from that. He says, sell in May and go away. What option strategy benefits from the profound market malaise? I like this guy. That occurs over the summertime. Interesting handle, well-written question. I guess that'll get you featured here on the show. So Dan here, he wants to know, we're not quite in summertime yet. We're in the throes of January here in Chicago, so it's hard for us to look ahead to that warm season, but it will come eventually. And when it does, usually things quiet down a little bit. Dan, when someone comes to you at an MTM and says, when it's sell in May and go away time, what should I do? What do you usually counsel them, sir?
Yeah, that's actually a really interesting little idiom. It started out traditionally, and I think most people still think of it as sell stocks in May, and then, when all the real traders, the big traders, spend the summer in the Hamptons, doing their shenanigans, then they, like anything can happen in the summer, there's too much risk, and stocks, can go lower in the summer. And then come back and buy later. But really, that phrase actually wasn't intended for this, but it has more application in options. Because volatility tends to be lower in the summer as a result of that as well. Now, that's definitely not always the case, but selling options in May and being short volatility through the summer can, a lot of years, be a real nice edgeful trade. Is that a word? Edgeful?
We'll allow you to coin a new phrase for the show, sir. Why not?
Yeah. So, selling options and being short vol in the summer can be a real nice trade.
All right, Mr. P, with that new phrase in all of our collective phrase books, we're going to call an end to this return to glory here for options. But it was fun, kind of fun getting back on the old boot camp drill instructor ground, wasn't it, sir?
Yeah, it was. It was great. Back in the saddle again, man.
Back in the saddle again. Hopefully to get a few of these out a month, at least one a month, so you guys will have something to chew on here on the old feed going forward. If you have topics you want us to discuss on the show, obviously questions, you have many of those, hit us up. You know where to find us at Options. Over there is the easiest place to do it. Or, of course, the optionsinsider.com or feedback form. All that stuff works as well, the mobile app. You can even help Mr. Passarelli over there at Market Taker Mentoring. Maybe he'll filter out some good ones and forward them over to us. Before we go, Mr. P, if people are interested in learning more about options these days, where should they go? What should they do, sir?
Yeah, head over to Market Taker online. We had a really, really great year this year. We launched a couple of new classes. One of them is our MTM Smart Income System, where we use the nail of the trade checklist to give you some guidance on the things you need to focus on to trade covered calls. And actually, I've got a free checklist. It's a PDF that you guys can download. Just go to markettaker.com/nailit. Market, like stock market, taker, like take something, two T's in a row, markettaker.com/nail-it. One word.
Yeah, don't forget the two T's. I always forget the second T. And I'm like, what am I on? So, yeah, two T's, listeners. Get it there. markettaker.com/nail-it. And you, too, can check out all the cool stuff Dan and his team have cooking over there. I'm looking at it right now. Nail the Trade Covered Call Candidate Checklist. We get that question a lot. How should I structure my covered calls? Which strikes should I be picking? In the money, out of the money, all that kind of fun stuff. So check out Dan's playlist here, his checklist, I should say, if you would like to learn as well. And thanks again for just in general continuing to love and support the show. You guys are literally the reason we are doing this. So don't worry, we'll be back with more. And we'll see you next time for more Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite program programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com. The Options Insider Radio Network is sponsored by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC.